Hey, Eric here from 5minuteinvesting.com, and today we're going to talk about leverage and low interest rate and what does that mean to the world. Now, I'm just going to talk a little bit about how leverage works, what does it mean to corporations specifically, and how does that impact the company's financial statements, and what are some of the trends that we have been seeing recently, and what's the end game and what's the worst case scenario. So I think this is an interesting topic because if you can get an understanding of leverage, that's going to put you miles ahead of other investors. So first, since 2008, interest rate has been really low. So essentially, the government has been pumping money into the economy. But what does that even mean? So let's break this down and understand it step by step. Now, the interest rate is what? 1 to 3%, so very low. And this essentially means that company can borrow money with little to no cost. Now, 1 to 3% is really not that much in the grand scheme of things. Now, let me explain what I mean. Let's say you're a retail company, and when you sell a product for $100, you make $50, and your product cost, whether you manufacture it in China or US, is $50. So your return on your inventory is really 100%, assuming you buy and sell it once a year. So your gross margin is 50% and your gross profit is $50. So pretty straightforward, right? Now, if the entrepreneur uses his own money, then of course it will be growing based on how much money he has in his bank account, how many inventory units he can buy, and then he can sell it back out, and then he will have more money, and then he'll repurchase more inventory, so on and so forth. Now, what happens if you add leverage in the mix? When you add leverage in the mix, you can continue to buy more inventory because you can borrow money. And when you borrow money at a 1%, 3% interest, then you're really only paying 50 cents to $1.50 when you're buying a $50 inventory. So if you think about the math, let's say today, instead of using my own money, I'm going to borrow a bank loan, and a bank loan of $50. So for that year, my interest is only going to be 50 cents or $1.50. And if I can sell the inventory, then I make $100 and I net profit is $49 to $47. So that is pretty good. So what does that mean? It means that any company with a gross margin greater than 3%, you can use leverage, assuming the revenue is stable and so on. So you can use other people's money to buy the product and so on to feed into your gross margin because you can scale, you can basically buy more units, and you can keep going and expand your business. And this is really the implication. If you can use leverage, then you can quickly expand your business. And if you can quickly expand your business, then in the market, you will start to see a lot of small companies rapidly growing and becoming big really, really fast. So when you think about that, this is why when you look at the China markets, you see a lot of companies growing really quickly. There are companies that open 100, 200, 300 shops in less than a year. Some even open over 1,000 shops. And there are e-commerce platforms that become like the third largest just through the use of leverage, whether that is operational leverage, using the business, some mechanism itself, or financial leverage. So what should you do in an economy where everyone uses leverage? When there is low interest rate, there's basically a flood of money in the market, and money becomes less important. Money is no longer the key constraint because you can just borrow a loan and you can get it for 1 to 3%. So in an economy where everyone uses leverage, scale becomes very important. And people who knows how to scale will become richer. People who are able to use leverage will become richer. And when you use leverage, which is another way of saying other people's money, and you invest in some sort of asset, whether that is real estate, whether that is stocks, then the asset value will increase because the value of money will decrease because there's so much money. So what's the end game? So let's talk about the positive side first. Now, if everyone uses leverage responsibly and ethically, and that's very important, then business will scale. There's going to be more good businesses, and they will scale as long as there is more profit to be made, and they will satisfy the demand because money is no longer a constraint. Imagine I develop a good product today, and I might need to do 100 units as a pilot test, but if I'm able to use leverage, then suddenly I can order 100,000 units. So money is no longer the constraint. The constraint is really what is the market demand, and I can keep scaling until my gross margin goes less than the interest rate, which is 3%. So over time, you're actually going to see there's more competition and it's easier to scale. So then the competition for the big players will also be stronger, and the companies will keep scaling until they satisfy the market demand. Now that is a very ideal scenario. That's assuming there's no recession, and that's assuming the economy continues to grow, which means the population continues to grow. All right, so let's talk about the downside. Now, what happens if there is a recession? What happens if there's a slowdown? Now, when there's a slowdown, companies with a poor revenue model, that means they don't make money consistently, they make money kind of sporadically, they aren't able to afford the interest payment. And even if it is just a small interest payment, they are not able to afford it because the inventory is not selling. So, whatever products they are launching is not working out for them. So they start defaulting. And when they start defaulting, then the banks who loaned them money will also start to default, and then they'll have to fire people, and then there's less spending in the economy. And then you can see how this goes kind of like a downward spiral. So then this will trigger more and more companies going into default, and that will lead to a recession. And this time, the interest rate is already so low. So is it possible to have an even lower interest rate? So then it caused people to make the right decision, or the government will have to find another way to solve this problem. So I think this is where we're at today. Interest rate is really low, the economy continues to grow, and companies are more leveraged than before because they can expand, they can use the loan to open new stores, they can use the loan to launch new products. But the downside is when someone starts to make mistakes and they're not able to pay back the loan. So this is what's interesting. And I think it's going to play out in the next 3 to 5 years when companies start to default, and that's when a recession hits. Okay, so let me know if you have any questions. And I do teach investing and how to get 30% from the stock market. I have a coaching program called Investing Accelerator, and it is a 4-week program where you can start with no financial experience, no prior history in investing, or if you have been a losing investor for many years, this program is for you. So in 4 weeks, I'll give you one complete strategy where you can get 30% from the stock market, and then you'll be part of this program. So you can click the button below to try a free module, or you can also schedule a free call if you have any questions. So that's it. Let me know if you have any other questions in the comments below, and I'll see you in the next video.